The macroeconomic headlines are likely to come from the USA in the coming week, thanks to a pair of potentially interlinked datasets. They're also due out on the same day, Tuesday the 22nd of February, which will see the release of the latest Case-Shiller House Price Index and the Conference Board's Consumer Confidence Survey. It'll be interesting to see just how resilient both are proving to be in the face of the Omicron variant, surging inflation, and the US Federal Reserve's allegedly tougher stance on monetary policy. The Fed has embarked upon quantitative tightening and prepared the markets for a rate rise in March. Both mean that US government bond yields are rising, and as a result, the 30-year mortgage rate in the US is on the move as well. The classic US 30-year fixed-rate mortgage will now cost 3.55% a year, its highest since before the pandemic began in 2020, although we should remember that will only affect new borrowers or those who refinance, and also, it's still very low by historic standards. Nevertheless, throwing a wobble in US stock markets, cryptocurrency prices and bonds, and Americans' willingness and ability to spend on property or indeed anything else might be about to be put to the test. Remember that last month, the Case-Shiller House Price Index hit the latest in a string of all-time highs as prices rose, on average, by 18.8% year on year. Now that did at least represent a slight slowdown in the terms of rate of growth, but the index now stands 50% higher than it did at its peak in summer 2006, a boom which ultimately proved massively overcooked, and prices are rising faster now than they did then. No wonder some people argue the Fed has let monetary policy run too loose for too long, and that asset prices have boiled over across the board as a result. The Conference Board's Consumer Confidence Index slipped a little in January to 113.8, but that was no great crime, as the reading was still way higher than it had been the year before in January 2021. Nevertheless, the reading has never come close to recapturing its pre-pandemic high of autumn 2018, or indeed the latest peak last summer, which coincided with the recent surge in inflation. Now, on the home front, the results season is in full flow. 18 FTSE 100 firms are due to report results, and a good number of mid and small caps are due to do the same. Companies which may be worthy of further research because of what they say about themselves, their industry, or the wider economy could include the following, although note that some of these dates could yet be subject to change at the last minute. Dechra Pharmaceuticals and Finsbury Foods on the 21st, HSBC, Antofagasta, Coca-Cola HBC and Intercontinental Hotels on the 22nd, Rio Tinto, Barclays, Go Ahead and Metro Bank on the 23rd, Lloyds, BAE Systems, WPP, Rolls-Royce, Howden Joinery, Centrica, Spectris, Derwent London, Serco and Aston Martin Lagonda on the 24th, deep breath, Grandstand finish on the 25th, from International Consolidated Airlines, Evraz, Rightmove, Pearson and IMI. But even allowing for that august list, the company which could just cause the biggest fuss in the coming week is Smith Nephew. The orthopedics to wound care to sports medicine specialist is due to report its full year results for 2021 on Tuesday the 22nd of February. Smith Nephew shares are down by more than a fifth in the past year. The company's dished out a couple of disappointing trading updates, where it's flagged supply chain issues, high shipping costs and increased investment. COVID has also remained a problem. Hip and knee replacements and other surgical procedures have either been crowded out by the viral outbreak at busy hospitals, or patients have simply been unwilling to take the chance of going in, and new variants have therefore also helped to delay the recovery in surgical operation volumes. But that might mean that Smith & Nephew could be a surprise beneficiary if, as and when the virus is finally beaten off. And back in December, Chief Executive Officer Roland Diggelman outlined what he called a new strategy for growth for good measure. The FTSE 100 firm is now targeting compound organic revenue growth of between 4 and 6% a year out to 2024, and an operating margin of 21% by 2024, with further improvements in returns on sales after that. Now, these goals are based partly upon promising product pipeline in orthopedics, strong growth in sports medicine and wound care, as well as manufacturing and cost efficiencies. The 2021 results will hardly be a fair test of those goals, but any comment made on the outlook for 2022 could be seen in the context as the first steps to reaching those targets. Meantime, the 2021 results will be benchmarked against the company's two key targets that it laid out for the year, although do note that management steered expectations towards the low end of both ranges alongside the November trading update. The first target is underlying sales growth of 10 to 13%. The first half was up 21% against the low base, the third quarter by just 2%, reflecting a tougher base and those COVID and supply chain impacts. Note that in the third quarter, 2 of the 3 operating units saw revenue exceed pre-COVID levels of 2019. Orthopedics was the only laggard, again due to those delays in surgical operations. The second target is an operating margin of 18 to 19%. Here, analysts have penciled in an operating profit of $940 million for a 17.9% margin, rising to $1.07 billion and 19.3% in 2022. Finally, attention will return to the dividend. Smith Nephew paid an unchanged dividend of 14.4 US cents in the first half, and analysts are looking for an unchanged payment of 23.1 cents in the second, for a total payout of 37.5 US cents a share, enough for a historic yield of around 2.3%. I hope that you and your families are in good spirits and keeping well. Thank you for watching, and I look forward to seeing you again next week.